So welcome everybody to the next edition of Market Matters. Look forward to having a discussion with everybody today about what's going on in today's pretty volatile market environment. I would just say, if you do have any questions, please feel free to drop those into the chat feature in Zoom, and I'll grab those and address them as they come through, either directly or offline directly with you as clients. And as always, if you have any follow-up, we'd be happy to follow up with you at the conclusion of this event. So with that, let's get started. Here's a brief agenda of what we're going to be going through today. Hank has joined us today. He's going to be sharing some remarks initially. We'll go into, from there, the economic update, which will be pretty brief because we haven't had a lot of data to chew on quite yet in Q1. We'll also touch on how what's currently going on in the markets is going to be affecting our investment outlook. And then there is a section I wanted to touch on here as well, what we call an evergreen investment concept, and that is the concept of maintaining a long-term time horizon. So with that, I'll turn it over to Hank. Hank.
Hey, thanks, Todd. There may be a few of you on the call that I haven't met yet. So for those, my name is Hank McLarty. I'm the CEO at Gratus, and it's great to see everyone by Zoom. This is probably the 6th time that we've had a Zoom meeting that I'm going to say the same thing, and that is we can't wait to get back to having group meetings where we do market updates and we're able to see each other in person and have lunch and talk and so forth. I keep thinking that's going to happen soon, and then we have to pull back. So hopefully, this summer or this fall, we'll be able to do it again and get back on a normal schedule for getting together in person. Normally I give updates on kind of some things that are going on with the firm and just, kind of high level updates. But I think today I really wanted to focus on giving just some comments about the market, because it's been such a volatile couple of months that we've dealt with. The S&P is actually over the last month down only 6%, but this time last week it was down about 10%. And an awful lot of the high growth names and tech names since November are down 50, 60, some of them down 70%. So even though the overall market's only down 6%, there are some areas of the market that are down substantially, well over 50%. So it's been a fairly volatile market as the Fed is talking about raising interest rates. And Todd's going to talk with you in a much greater detail about that today. I just wanted to share with you some things that I've observed over the 30 years that I've been working in the wealth management area and working with clients. So obviously over 30 years, I've seen an awful lot of up and down markets, and every down market starts with a different catalyst that kind of kicks it off. Sometimes it's interest rate related inflation. Sometimes it's a region of the world that is in chaos or what have you, or a war has started. But whatever the reason is, it's typically a different reason every time, or a different scenario. But having a 5 to 10% pullback in the market is really normal. It's happened 84 times in the last 75 years. So it's something that we should expect to happen at least once a year, if not twice a year. The fact is, the last several years, the market's been, other than the pullback we had during COVID, which, then the market bounced right back. Generally, the market's been pretty smooth for the last 4 or 5 years, other than that brief pullback during COVID. So experiencing volatility in the market is kind of normal. Expecting the market to be down or flat 1 out of every 4 years is normal. And we've had a pretty awesome up market for a while. So the Fed is going to be withdrawing stimulus from the market. They've already announced that. Typically when they announce that, which has happened many times over the decades, the market overreacts to the downside. The Fed starts raising rates. And then typically what happens is the market kind of settles in. And as long as the economy is strong, it resumes its uptrend. It may be a little less of an uptrend than what it was before as the Fed raises rates, but we don't see any reason to be alarmed. Again, a normal pullback in the market of 5 to 10% is what we should expect on a fairly regular basis. But as long as the market is going up more times than it's going down, that's why we invest in stocks. And 57% of the time, the market is up over 10% in a given year. So the averages are on our side. Todd and his team are doing an awesome job of selecting stocks and bonds and the different investment options that we have. I will say that our two private funds, Trailhead Income and Trailhead Growth, are great places to be investing right now, primarily because they're offering really good opportunities for both income and growth, but they're doing it in a way, for the most part, that is not marked to the market. So the companies that are down 40, 50, 60% that you're seeing, some of the higher growth names since November have been down a lot, they're still executing their business plan. Most of them, their earnings haven't gone down at all. They're still doing the exact same things they were doing when the stock was up. It's just the market is fearful of the Fed raising rates and what that may do to valuations in the future. But these companies are still executing and doing the exact same things that made them the hot stock, several months ago. So the private side of the market allows you to invest in income deals and growth situations that are not necessarily pegged to the market, and the valuations kind of stay where they should because they're still categorized as private and they're not moving up and down with the public market. So either way, Todd and the team are doing a great job with the investments. Pullbacks like this are absolutely normal. The only time we would get alarmed with a pullback is if we're expecting a severe recession. That's when you start seeing pullbacks of over 15 to 20%. But as Todd will talk through today, at the moment, we don't see any recession on the horizon, but in fact, the Fed trying to slow down the economy and slow down inflation. So with that, I'm going to turn it back over to Todd. As I said, it's good to see everyone again, looking very forward to seeing everyone in person. And Todd, back to you.
Thanks, Hank. So as Hank mentioned, we'll kick off here with as we always do, with a quick economic update, which I think does a useful job of helping frame out what the macro conditions, if you will. So as Hank alluded to, a lot of the more recent pullback relates to the announcement that the Fed will be scaling back not only asset purchases, as well as potentially raising interest rates. In other words, all tools are still on the table. And you can see pretty clearly here that right around the time that those Fed minutes were released in early January for the December Fed meeting, the market really has started to discount that as a possibility. And so what this has, of course, done is led to a little bit of a pullback in risk markets. But again, this is something that's more of an impulse or reaction as opposed to what's likely to happen, in our opinion. Recession-wise, recession is defined as 2 back-to-back quarters of negative growth in an economy. We just came off a year where it looks like the U.S. economy grew somewhere between 4 to 5% on average when all said and done. And now we're starting to get estimates for what does Q1 look like. And this can be a very different range of opinions throughout the course of the quarter. You can see the average economist still has a estimate of somewhere between 3 and 4% for Q1. The Atlanta Fed does, however, put out what they call a nowcast, which takes all incoming data that's real time and tries to match it to a likely outcome. The Atlanta nowcast has the Fed or Q1 GDP at 0.1%, which, although positive, is kind of right there on the razor's edge. And our guess is that the economy will come in somewhere like between here and there. So still have a bit of way to go before we can declare a recession is likely on the horizon. But also I would suggest too, that a lot of how fast we either get to a recession or not will depend on how aggressive the Fed wants to get in tightening financial conditions. And so it's an area that we're keeping dynamics within the Federal Reserve are something we keep a close eye on. But I think at this point, it's still not a negative or a positive because it's still too early to tell. Housing market continues to be a source of support for the economy. I think there's no question about it, where you are seeing record low levels of inventory. I think I've showed the chart before, but we're at just below a 1 month average inventory across the US for housing. So what that tells you is that this is a supply driven market still, not necessarily a demand driven market, but let's address the demand side briefly. And that's what this chart is meant to talk to a little bit. You hear a lot in the media about how important low interest rates are to house price appreciation. And I would say generally directionally that's true, but it's important to understand that there are periods in time when that is not the case. And I think this does a pretty good job of sharing what some of those time periods were. And those are actually very recent periods to show. And you can see here, I mean, even in the early days of the 1980s, which my parents will talk about all the time, about mortgage rates, comparing what I have versus what they had to take out with their house. But you can see interest rates in 1980 to 81 went from 12.2 to 18.4%, which actually didn't kill the housing market. I mean, if anything, it created more of an impetus to buy and lock in whatever rate people could. And I guess that's kind of the idea here, is that I don't buy into the notion that rising interest rates will kill the housing market, because there's really just not a lot of data to suggest that will actually happen. As a matter of fact, if you look at Europe as an example, with a very tight housing market, and some of you may know, I lived in Europe for about 5 years. Their housing market has stayed very, very stable through a variety of market conditions, regardless of what mortgage rates are doing. And the mortgage market, I understand, is very different there, but that notwithstanding, housing continues to be, I think, a supportive stool in the economy at the moment. One area I did point out as a risk to the economy, which has kind of fallen off the front page, but something that I definitely want to bring back into focus a little bit, because it's something that is getting a little bit of traction or action, and also speaks to why we exited our EM position over the last few days, has to do with the chart right here, which we all understand that, I think from what I've told you over the last few months and in publications, the Chinese property sector is definitely a risk for global markets. And this is, I think, the proof statement as to why. So what you're seeing are 3 asset categories in trillions of dollars. So let's take the US here. And at the end of 2021, US residential property market was valued at roughly 34 trillion. US fixed income market was valued at roughly 48 trillion, and US equity market at 47 trillion. And what should stand out here is the Chinese property market, particularly relative to the fixed income and equity market, is, by some estimates, as Goldman points out here, likely the largest property market or asset market in the world. And that's, means that we need to pay attention to what's going on there. So the good news is that the Chinese are aggressively addressing what's going on with Evergreen, but also other Chinese property developers that have ruminated some issues within their balance sheets. But something that we're definitely keeping an eye on, because that can be a source of exogenous risk to the US that we definitely want to make sure that we're aware of and monitoring. So just briefly, I mean, not a lot has changed from an economic perspective since the last quarter end review we did in early January. Roughly speaking, US economy should grow somewhere between 2 and 3% this year, a little bit above trend, inflation decelerating. And so within that context, I think there's things that we can still do in portfolios. One is we recently upgraded small cap to a more neutral weighting, and we have started adding mid cap and small cap exposure to some of the core equity strategies. Because if you're looking at differences between how these positions have evolved, you can see it's really been a pretty remarkable case study for how looking at relative differentials can be very value additive. One thing we did do last quarter was we downgraded emerging markets to a less attractive position, meaning that as a result of this downgrade, we actually exited our emerging market position within the last couple of days in favor of a global strategy that can add to emerging markets if they want to, but not that they have to. And so we think that added flexibility is a nice byproduct or upgrade. The bond market, generally speaking, there's not a lot of great opportunities there. And again, this factors into our idea and belief that the bond market right now is really meant for capital preservation as opposed for income generation or even risk seeking. As many of you know, we've had a negative viewpoint on the junk bond market. And actually, I think last Friday, junk bonds had their largest outflow ever from a flows standpoint. So maybe some people are starting to pick up on the idea that junk bonds aren't really a great place to be if your best case scenario return is somewhere between 3 and 4%, just not very attractive. And of course, as Hank alluded to, we have upgraded or kept consistent our belief that alternative assets and strategies are a good place to allocate capital at the expense of the bond market. It's just we have to understand what risks or unique considerations we're taking on in doing so. So here's just a few portfolio notes that I wanted to share, and we have actually taken these opportunities with volatile market conditions to take some actions, and I'll go through those as we go through them. But just in general, we are definitely being very mindful of risk and return across various asset categories, and this is where I was referring to evaluating additional asset allocation adjustments. And just to give you a bit of a preview, we're looking at further reductions potentially within our fixed income sleeve. And allocating to alternative income sources or other alternative strategies that might be filling that gap between equity returns and bond returns. We still believe that having portfolio liquidity is going to be important. We're using a short-term, ultra-short cash ETF or bond ETF to fill that position. So if you see some ultra-short-term ETFs as a bond strategy in your portfolio, that's really our cash proxy. One thing I didn't want to touch on here, I don't want to gloss over, is that we still have negative, what they call real yields in bonds right now, which means that when you account for inflation, that the return on your bond portfolio potentially is negative. And this is one reason why we're considering incremental exposure to other areas in the portfolio. On the equity side, this has been probably the most volatile conditions we've had since March of 2020. Again, I would just point out there's very large divergences or dispersion between asset categories. We can't make broad sweeping generalizations as easily as maybe you once could about things like growth versus value. But I think there's some evidence to suggest that there are opportunities amidst all of this turmoil, and that we have been pretty active in adding to areas that we find attractive, truing up positions that have sold off a little bit, or even reducing and adding new positions, which we'll talk about in just a minute. We did use the opportunity and within the volatility to exit our emerging market position. Actually, in Q1, so far in Q1 in January, the EM position held up quite a bit better than the developed markets position that we were replacing it with. So we thought that was a great opportunity to replace that exposure, consistent with our idea that emerging markets will be a bit of a challenging sector to be in with all this currency volatility and equity market volatility. Fixed income, we continue to keep this pretty short in duration, and fairly high quality, because we want this to be the portfolio balanced. And with inflation, it is leveling up to a higher level, I think, on average, but still likely to come off the more recent highs of 6.5%, 7%, down towards a more normal trend rate of inflation in that 3 to 4 range. Still nothing super low like pre-COVID, but certainly it's coming off, and we're starting to see evidence of that. On the alternative side, this is somewhere where we've gotten quite a bit more active or interested. This, as I say here, intercompany dispersion is creating really good opportunity sets for active strategies to take advantage of volatility. So things like long short equity or arbitrage strategies are making a lot of sense, and those have made their way into the portfolio more recently. And then I still would suggest, I know this is an idea or a topic that's on a lot of people's minds, but Gratus, us personally, we haven't taken any liquid portfolio position in Bitcoin quite yet, just because there is, well, first of all, we need to have a thorough discussion about it at the investment committee, but also the vehicle to do so is still suboptimal in our opinion. What we have right now is futures-based ETFs, which I think are a poor substitute for the actual, spot Bitcoin ETF, which we'll likely take a hard look at whenever that's available. So with that, I just wanted to turn here to inflation and just give some context around what is going on with inflation and kind of when it's super detrimental, as we all kind of been conditioned to think, and then maybe when it's not. So what you see on the screen here is rolling 12-month inflation periods on the bottom here, below 0, 0 to 2, 2 to 3, and above 6. And then on the top here, you can see that the light blue is equity returns during these periods of inflation and fixed income returns during these periods of inflation. I think the point is that cutting off or minimizing exposure to the tails in inflation is really what we all want to try to do here with portfolio construction. So is there a possibility that inflation stays above 6%? Sure, there is a possibility that could happen. And we want to make sure we account for that with a appropriately sized position. But I think the good news is that if inflation does trend below and back into this normalized range, that we're not really into these tail risk areas that have some pretty adverse outcomes on an annualized basis for both stocks and bonds, particularly. So just wanted to make sure and this is from data from 1970 through November of last year. So as long as we can stay out of these inflation or these tail areas, I think we're going to be fine with that regard. Another piece of good news that I think shouldn't go overlooked as well is that earnings season has been off to a good start. And I think that's always kind of been our base case here, is that while we understand that the PE multiple on the S&P 500 is trading on the higher side, two things. Number one is the sell-off actually did a pretty decent job of bringing that multiple down. So at the start of the year, the PE multiples are around 22. And at the end of January, of somewhere in the neighborhood of 18.5, something like that. So that's one. The other piece of good news is that earnings continue to surprise to the upside in the S&P. So what you can see here is that through January 28th, roughly a third of the S&P has reported earnings for Q4 so far. And I think the results have been pretty encouraging. And what you see that coming through here and what the expectation was, which is the gray bars on December 31 versus the blue bars, the reality of what's being reported. And just to net it out on the S&P, the market expected earnings to grow year over year in Q4, 21%. But what the S&P is actually showing is growth of 24%. So a nice positive upside surprise. And as Hank mentioned, are we supposed to be fearful of the rate hiking cycle? And I think, as you'll see in the next slide, there's some conditionality to that. But on average, if you look through the entirety of the cycle, when the Fed is actually raising rates, from when they start to where they end, the experience has actually been pretty positive for markets. And I know that's not something that a lot of people relate, because I know the knee-jerk reaction is to think, well, if the Fed is hiking rates, then it must be bad for markets. And that's actually not the case. Now, if we come into a stagflationary scenario like we had in the 70s, which was the lone standout here, where we saw negative returns over this time period, that could prove to be the exception to this chart. But I would say, in 80% of the time or 90% of the time that the Fed has been hiking rates during these time periods, this is every time period going back to the 1950s, that it's actually been a positive experience, because remember, the market is a forward-looking entity, and so the market tends to look through Fed rate hikes and through to the other side of what might be on their side, 6 to 12 months out. Now, we did have, I would say, a very visceral and short sell-off, and this actually turns out that the 2022 time period is one of the quickest times or number of days to a 10% drawdown. So these are the other time periods in history where the market drew down 10% in less than a month. And it took us about 14 days to get to a down 10 in the S&P from peak to trough. Good news is that, in almost every other situation, the 3 month, next 3 months, next 6 months, next 12 months is pretty positive and in a pretty meaningful way. Now, not 100% of the time, as this experience in 2000 shows, but the odds are definitely stacked in our favor. So that's something that I think gives us a little bit of comfort that this might just be a more of a palate cleansing than the start of something bigger in the S&P. The key variable, as Hank alluded to in his comments, though, is are we getting a drawdown in a recession or a drawdown that's not in a recession? Because the distinction matters. So if it's not a non-recessionary correction, this goes back to the data from the 1950s. It averages about 120 days, so about 4 months. We're 1 month into it. The average correction is about 15%. So if we went down 10, that might suggest there might be a little bit more downside to go from here and more duration or more time to go from here. But that's actually fits pretty nicely with the midterm election cycle chart that I showed at the last Market Matters, that shows that during the first 7 or 8 months of a midterm election cycle year, markets tend to be flat to slightly negative, and that would certainly fit that template. But if we are in a recession, then these drawdowns tend to be far worse. And you can see that's kind of what happened here in March of 2020, where we actually went into and out of a recession the quickest ever, and we got, as it turns out, almost exactly a 30% drawdown in the S&P from peak to trough. We have had some questions from clients relating to the growth value dynamic, and I showed this chart during the last Market Matters, but I think it's useful to revisit. And one of the reasons I think this is useful to revisit is because, so just for reference, if this line is going up, that means growth is outperforming value. And if the line is going down, that means that value is outperforming growth. You can see within the last, over the last 45 days that value has dramatically outperformed growth. But I would just suggest that this is a lot of choppiness. This is a lot of sideways activity, and really not an investable trend quite yet. We would have to, as I pointed out in earlier Market Matters, we'd have to see a break below this ratio right here to suggest that the growth value paradigm is changing in a meaningful way. And until we see that, I think a lot of this is just noise, and it's going to be a sideways market activity with a lot of volatility along the way. How are we approaching this growth value allocation decision? Well, I think in the absence of clarity, your primary response function should be to equal weight. So we have in our U.S. Large cap core, U.S. equity strategy, we have an equal weighting now to both growth, large cap growth, and large cap value with some mid cap core sprinkled in there. And so I think our more recent equal weighting of those styles tended to be actually a little bit overweighted by a couple of percentage points to growth coming into 2022, just given how well those positions had performed. We're definitely now at a definitive equal weight. And I think that in the absence of clarity is the baseline position right now. And then we just come back to this idea too about international. This is one of the areas I would suggest we can start looking and have been looking at positions on the developed market side. Emerging markets, I've already mentioned that those are unattractive for a variety of reasons, primarily for exogenous shocks like what China is presenting at the moment. But we have to recognize we've been in a substantial underperformance of the international stocks versus US, the longest in history, given how records have evolved over time. And this is why we still continue to recommend to all of our client portfolios that we have a 30% weighting on average in your equity sleeve, just so that we get that diversification benefit from owning international, which frankly hasn't been there over this entire time frame. So relative to what we could be at, which is a global benchmark at 50%, we think a 30% position is a meaningful enough position to make a difference, but not too overweight to impair returns substantially. And then just going to fixed income briefly, I showed this chart last time, and it's remarkable that despite the fact that we, since this time, have received the highest inflation print since the 1970s, that we're still in this range for fixed income of below 1.8% in the 10-year bond. I mean, it's hard to contemplate what's keeping a lid on this, but there are a number of different reasons why that could be the case. And I think using a number of different touch points, one could be international investors, because remember their yields are much lower in international markets, are finding a 1.8 yield attractive relative to their negative yields potentially. The other would be is that the market is seeing through the more recent inflation over the 10-year horizon and saying, well, okay, maybe it's not going to stay at these levels for a whole lot longer and trend back down to that to 3% range. Either way, I think the bond market is not giving us all the information, and in that way, longer term, yes, yields will likely creep up, but not explode higher like some I think have forecasted would happen. Because we also are fighting against this. This is, as some call it, the chart of truth, which shows the 10-year bond yield going back to the early to 1980. And what's the chart of truth telling us? Well, it shows you, of course, back in 1981, too, we saw 10-year bond yields at 16%. Really attractive. I don't know why anyone wouldn't have jumped on that back in the early 80s. What we can see is here a fairly persistent, starting in 1986 and forward, a pretty persistent downward grind in yields. And I think until we poke above this well-established trend channel of the 10-year bond yield definitively, and that would be going up to 2.7 or 3% or something, then it's hard to say that yields are going to explode to the upside, because there are, we must admit, a number of factors keeping a lid on this, as we talked about. One of them, labor force dynamics, which I didn't mention in the previous slide, could be one of those features keeping a lid on things. So here are some takeaways before I get to what I consider an evergreen topic. And this hasn't really changed a whole lot since last month, but I think it's definitely worth reiterating, is that we have and will continue to have an overweight or a favor of stocks over bonds. So what does that mean? It means, pre-COVID, where we had a 50-50 recommendation to a client, we would likely now have a 60-40 allocation between stocks and bonds to a client, or maybe even higher, depending on circumstances. This is informed by our capital market assumptions. So I would encourage people to take a look at that. You can talk to your advisor and request that, because these are publications that should inform us as to where we believe capital will be treated the best over the next 10 years. And active strategies are becoming increasingly preferred, I think, on the equity side, because of the volatility that we're seeing. Alternative strategies, we continue to favor those over bonds. So this is one area that we'll be likely increasing our allocation as time goes on. And I think that's, these alternative strategies are ideally situated to benefit from the rising volatility that's in front of us in both the equity markets, but also in the bond market. And then we are looking at new ways to access asset classes. The one I'm referring to here is digital assets, but also through our trailhead growth strategy. We're looking at getting exposure to venture capital and even some unique hedge fund strategies with co-investment opportunities. And we'll have a bigger update on that for those clients that are interested in that. But these are previously areas we hadn't had a lot of exposure to that we are looking to get small access to at some point. And then finally, I just wanted to mention 2022 will be, in my mind, continue to be a year of blocking and tackling. When we did our first Market Matters in January, that was when the market really hadn't done anything. I think it was on January 3rd or 4th. And the market hadn't had this big drawdown. And what does blocking and tackling mean? Well, I think we could point to some things we've tangibly done over the last few weeks to speak to this. So blocking and tackling means taking advantage of tax loss opportunities early in the year whenever you can. This is a big service or a big value add to portfolios if you're taking advantage of what I call a deferred tax asset, meaning offsetting gains, and replacing those strategies with like proxies is one thing to do. You also can, as we've done over the past weeks, use the opportunity and volatility to adjust positions. So some examples of that would be selling out of our emerging market position and adding to international developed market positions. That'd be one, or also scaling back our small overweight to growth strategies and more equal weighting to a more balanced picture of growth versus value. And those are in the core strategies. In the single stock strategies, you may have noticed additional, because there's many more positions in there. We've used the opportunity more recently to top up positions that had sold off a little bit, or even add new positions to the strategy. So adding diversification, adding some durability to the portfolios. blocking and tackling. I think that these are tangible things we can be doing when markets go a little sideways on us. And I just want to spend a few moments here on an evergreen concept that I think you'll find interesting. And I touched on this back in March of 2020, but I think it's useful to revisit it when we get, finally get periods of volatility. And that is the importance of being an equity investor requires that you take a long-term time horizon. Because I know more recently there's been some clients that have been a little anxious about what's going on with the equity portfolios. Some of the movements and machinations within particularly the growth side. And I would say that the answer usually is if there's no, like in the case of one of the positions that's moved against us here recently is the Morgan Stanley Growth Fund. If it's a high quality team that's executing the same strategy that has made them very successful for the past 20 plus years in the growth side, that usually giving them time to work through the strategy is the right answer. And I think this chart does a great job of explaining why that is, because you can see here over any daily time period. So what you're seeing is from 1926 to 2018, the percent of the time the market was positive, percent of the time the market was negative, and then moving out into a 1 year to 20 year time period, best return, worst return. And so, on a daily basis, the market's it's more or less a coin flip, although biased a little bit to the positive side. So that works in our favor as to, why you would even want to be an equity investor in the first place. If it was percent negative, then that wouldn't be an attractive risk reward. You can see here, as we move out the time horizon, your odds of success or having a positive return, assuming you don't change anything or liquidate or something like that, get exponentially better. So you have roughly a 75% chance of a positive return at a rolling 1 year time frame. And again, this goes back to 1926. So we are pulling in very negative periods for the market, like the 20s, a latter part of the roaring 20s, the recessions of the 1950s and 60s, stagflation in the 70s, the dot-com bubble in 2000, GFC in 2008, and the like. And once you get out to this 1 year period, though, you can see this is why I keep telling clients the 1 year period really isn't even a great window to evaluate whether or not you've had a successful investment performance when you're looking at active strategies, because you can still have these very disparate outcomes in a 1 year time frame. 25% of the time it's going to be negative. When it's negative, it's going to be pretty brutal. On the worst return over this time series was negative 44. Go back to March of 2020, you were at a negative 30. So these things can happen. However, if you just step it out to a 5 year window, your odds of success get far greater. So you're at almost a 88% positive percent rate. Best return is 27.25 over this time frame, rolling 5 years. Worst return collapses to 6.14%, which is really interesting, the difference between those time frames. Rolling 10 year, the picture gets even better with a barely negative return over that 10 year rolling period of negative 2.5. And then what we should all hope to be getting to is in our retirement accounts and equity accounts, rolling 20 year period, 100% chance of a positive return. Best rolling 20 year period is 17%. Worst is positive 5. So this is why it's absolutely critical to maintain that longer term time horizon, and also I think trust in the process, because that's when we deviate from process, that tends to be where things go sideways, and we definitely want to make sure that we're not making any changes that because we need to, but because we want to. So with that, I'm going to open it up here for questions. I know there's been one or two that have been thrown my way already in advance of this call. So let me just address those here. And then if anyone wants to, drop in any additional questions, I'll try to grab those one at a time. So one of the questions that came across, actually the one that came in the chat feature here is, what is the value add of cryptocurrency? This is a topic for a longer topic for a discussion, I think, and I have a slide deck that I'm trying to format for to distribute to all of our clients. But I think this is one of those topics that has a really useful reason to discuss it because it's new, it's novel, there's limited utility in a lot of people's minds. But I think we're in a period in time now where these assets are 3 trillion in value, these digital assets, all together. And that in and of itself, I think, should force the question of, well, what does everyone else find attractive? I mean, just briefly, who's buying crypto, Bitcoin and digital assets, and why would they do that? Well, there's the store of value argument, I think, to cryptocurrency or digital assets, equating Bitcoin to digital gold. And gold is in the same category as, yes, it's a tangible physical metal, but has a very similar utility function to it in that you can't buy groceries with gold. You can't store very much of it very easily. And historically, yes, it's been a decent hedge for inflation, but not in every period. So I think by and large, the Bitcoin argument and what the value of something like a Bitcoin or crypto is that it's a digital store of value, digital store of wealth to really hedge against what a central government or central bank might do with their currency. Because you get into what are governments doing, printing money essentially to, pay for programs that aren't funded. And that creates a lot of anxiety around with a lot of people and clients of the sound money type. And I think it's a conversation for probably a much longer discussion, but I think it's definitely a question that I would be happy to speak in more detail about. Another question that came along was actually more of a reference from an article that was sent my way, which was a Barron's article over the weekend about high dividend paying growth stocks and the questioning the value of whether or not they would be able to hedge against inflation. And my thought and my perspective on dividend strategies have always been that, having high yield growth stocks, high yields dividend paying stocks in a portfolio will not help you as much as you think it will. I've always thought that, because typically if you're in the high yield dividend paying stock sector, you're in very slow growth, anemic businesses. And AT&T, I think, is the case study, as a poster child for this. AT&T, through today announced they would be spinning out Warner Media. At the same time, they also announced that they would be cutting their dividend after the spin out, which I guess in some ways kind of makes some sense. But we have owned AT&T on and off and have exited for reasons that I think make some sense, because if you look at their end growth markets, the utility, telecom utility, with some media businesses on top, and those businesses just have not been in high growing sectors of the market. Therefore, every year that goes by, it puts their dividend at risk, and that's something that is not necessarily going to work well in an inflationary environment per se. However, if you find businesses that are growing their dividend very rapidly, that are paying only a very small percentage of their cash flow out, that tends to be a much better hedge for inflation, because they're raising the dividend faster than inflation is rising. So our thought has always been having companies that have maybe more of a modest dividend, but the ability to grow it out of cash flow is a much better approach, as opposed to in the high yield dividend section of the equity markets. Just wanted to say thank you for tuning in. We look forward to speaking to you again sometime soon. And if I can answer any questions as a follow-up, please let me know. We'll talk to you soon. Thanks, everybody.